This is the Chicks of FinTwit, a finance podcast by women for everyone. I am your host, Caitlin Cook. Join me as I highlight female trailblazers and their male allies across the industry as each shares their expertise on a variety of finance topics. Nothing is off limits. Thanks for joining us. Now please enjoy this episode.
All opinions expressed by Caitlin Cook and the Chicks of FinTwit podcast guests are solely their own opinions and do not reflect the opinions of the host or any of their affiliates. This podcast is for informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities, nor is this an offer or sale of a security. Hello and welcome to the Chicks of FinTwit podcast, a finance podcast by women for everyone. I am your host, Caitlin Cook, otherwise known as Dead Kate Bounce on Twitter in some circles. And this week we have a special guest, Selina Troesch Munster, partner at Touchdown Ventures, a venture capital that manages venture capital funds for large corporations. One of the first guests that I have on that I haven't actually had the pleasure of meeting before. So Selina, welcome to the show.
Thank you so much. I'm really glad to be on with you.
I'm super excited about this one. So I actually met Selina through her husband, Brett, who we work pretty closely with for content creation for OnRamp Academy in my role at work. So heard really good things about you working in VC. Super interested to hear about this. But first, maybe just give our listeners a little bit of information on your background.
Yeah, absolutely. So I have been with Touchdown for almost 7 years at this point. I joined the firm at the very beginning of its life. The company was founded in July of 2014, and I joined as an intern in business school in the fall of 2014, around October. And so I've been in the VC game for about 7 years. Before that, I was in business school at USC, very much focused on entrepreneurship and finance. And before that, I was at Barclays Investment Bank for about 5 years, doing mostly valuation work on structured debt instruments, which is about as dry as it sounds, and about as disconnected from sort of real human beings as it sounds. I loved how analytical it was. I loved how it tapped into my sort of problem-solving brain, but the fact that we weren't actually building anything or, didn't have direct impact on people's lives or the people who were sort of building the homes or the strip malls or whatever else the assets were based on, made me really want to transition into something more people-driven where we were actually working with entrepreneurs. And so that was the drive to get into business school. That's actually where I met my husband. And Touchdown drew me in because it's differentiated in the venture market. So, within VC, you've got traditional funds, you've got corporate funds, and then there's us. And we sort of sit at this intersection of institutional, traditional fund expertise and process in service of corporations. So we manage 18 different funds for a variety of different institutions that, are everything from Kellogg's to Scotts Miracle-Gro to Allegiant, T-Mobile, a number of other players that cover a bunch of different industries. And so my focus currently is on our fund with Scotts Miracle-Gro. It's called 1868 Ventures, looking at innovation in growing broadly. So really, really excited to be working on that one. But I've worked on a number of different funds over my time with Touchdown and have seen a variety of different industries and sort of best practices over the years.
Awesome. Well, I'm really excited to dig into all of that. First of all, though, on the VC side, bit of a VC personally as well, you and your husband, who are both wonderful. And I do not say that for the fact that you are investors in OnRamp Invest. So I thought it would be kind of cool to start out with that just because personal to both of us, right? Like you made an investment in the company. I work for the company. I've seen it grow. We're doing rounds of funding and I'm not super savvy on the VC space, but I'd be curious, even from like a personal perspective in your work professionally, just I don't even know if this is too vague of a question, but what you look for in companies. I mean, I'm sure it depends on the fund, but even with, OnRamp, and is there anything consistently across the board that you look into other than obviously a potential for high growth?
Yeah, no, potential for high growth is really critical. But that potential is impacted by a number of different factors. And so, step one is let's identify companies that fit our strategy. With angel investments for us personally, right? That's our strategy is stuff that's super early that's going to take a tiny check. But more broadly, if you're a fund or if you're a bigger pool of capital, typically you've got a strategy that says, what sectors do we invest in? Do we invest in agriculture? Do we invest in food? Do we invest in enterprise software? Let's narrow down the world of startups to companies that operate in that sector. Okay, great. We've got companies that operate in that sector. Now, what stage do we invest in? Do we invest in companies that don't have revenue yet? Do we invest in companies that have product and market? Do we invest in companies that have figured out their business model and are taking off and using our capital to just grow really, really fast? All right, we've narrowed down the universe to the companies that are at the right stage. Sort of last but not least, what geography do we invest in? Are we Bay Area only, not Bay Area only, Midwest, US, North America, South America, global? Where in the world do these companies operate? You narrow down your focus again. So that's sort of how you come up with your universe of startups that are relevant to what you invest in. And then from there, different investors have different priorities in terms of how they evaluate companies. And from what I've seen in my experience, it also very much depends on the stage. So at the seed stage, before you have revenue, before you have a lot of customers, what there is to see are the people. So what is the idea? Are these the right folks to be attacking this idea? Is there good fit between the product they're bringing to market and the folks who are bringing it? Have they identified an opportunity within a really big potential market? One of the famous examples is Uber, right? A lot of people evaluated that as a taxi opportunity, but really it defined a new market category that had much bigger potential than just taking all the revenue away from taxi companies. And so the people who were early investors in Uber had that insight of, what? Yes, this is a black car business, but this can get much bigger than that. And there are revenue opportunities beyond that. And when I talk about a market, I'm talking about how much money is available to capture. So at seed stage, it's very much about do I believe in these people? These are the people who are going to shepherd this thing through its life. A lot of times they don't make it all the way to the end, but these are the folks who are responsible for that. And I'm putting my money and trust in them. So a lot of it depends on what do I believe about the management team. As companies get a little bit further along, there's revenue, there's evidence of customer adoption, there are customers to talk to. I put a lot of weight into those customer reference calls. So when we're performing diligence, we reach out to folks and say, dear CEO, love your company, want to do more work on it. Can you introduce us to a couple of customer references so we can learn about their experience with the product? And this is obviously relevant for business to business more than it is for consumer businesses, but we want to understand, what's the relationship the customer has with the product? How are they using it? Do they see the relationship growing? Really glowing customer references make us confident that there is a market there and that the business can continue to grow, not only by adding new customers, but also expanding their relationship with existing customers. And then once you get more to the growth stage, you have a lot more sort of financial history to look at. So then you start to evaluate much more based on, does this business model work? Are they effectively managing their costs and, taking marketing dollars or salesperson dollars and turning that into revenue in a predictable way? And so at the different phases, there are different things that are important, but it's really all about people, all about the market, and the ability to have sort of a repeatable business model that works.
That was all awesome. I'm curious specifically when you talk about the people, right? And that's so important, especially beginning stages of building anything, right? I think I was within top 15 of OnRamp, and I feel like if you had any few people at the top that weren't in the spots that they were and were replaced by someone else that just kind of tipped things the wrong way, that it would have been entirely done. So from in and out, how do you analyze that though? I feel like that so much of that is having that social emotional IQ. Is that something that I mean, it's obviously necessary at that stage in the game, especially in like, seed stage, but I know that's always important, but do you feel like that's the most difficult part is like vetting the people? Because I feel like that's different depending on every single person that you ask, and the network that you have and that you've cultivated is super important to getting good information on all of these people.
Yeah. And one thing that I'll say before I answer that question is it's a two-way street. So entrepreneurs should also be sort of doing reference checks on the VCs that they're going to take money from. I mean, not everybody has that luxury, but this is a long-term relationship, especially at the seed stage. And you're going to have, these folks on your cap table for possibly a decade, maybe longer. And so, understand who it is that you're, getting into partnership with really is important. But from, the VC perspective in vetting a management team, it can be really, really difficult. And getting reliable references on folks is important. And it's also a reason that it's important to build relationships over time. So you're able to see, is this team building momentum? Are they able to make progress they say they're going to make? I mean, nothing is linear in a startup. Nothing is ever going to go according to plan. Maybe one in a million times. But seeing how that team reacts to different situations over time when they're not in fundraising mode is really valuable. Our best practice at Touchdown is to do that and build relationships. And if we have the luxury of taking some time to get to know the entrepreneur, that's really helpful. In the absence of that, reference calls are really important. We do our best to both do obviously listed references where the entrepreneur has given us some folks to talk to that they've worked with. And the questions that we ask there are very much about like, what is this person like under stress? If we do make the investment, how do we help manage that stress? How do we recognize it? How do we create an environment of sort of trust and collaboration with this person? And what are their strengths, and sort of similar to how you would do sort of a hiring reference, what are their strengths and weaknesses, and how do we amplify their strengths and provide support for the weaknesses? On list or sort of the given references are often going to be very positive. And if they're not, that's kind of a red flag. What we also try to do is identify folks in common, where we're able to reach out to somebody that we know well and say, I see that you're friendly with this entrepreneur. Can you, share your thoughts on them as a leader, on them as a collaborator with their board members and shareholders, and any sort of thoughts and things that we should be aware of. My boss, Scott Lynette, who's the president of Touchdown, wrote a piece about a reference call that turned him off of a deal because of ethics. And the person who gave the reference very much said, like, this is a person that I would never do business with again. And that's a very clear signal that you probably want to think twice about making that investment. But on the flip side, it can be really, really hard. One of the conversations I had with my team recently was, okay, the management team at this startup is unproven. They haven't been executives at big companies. They haven't, this isn't their second or third startup. They don't have a lot of evidence that, they're really great startup leaders. And the devil's advocate to that is, okay, yes, on paper, these folks don't have all those experiences, but there's your first company. And that first company may very well be a success. And I, also want to look at the data from the business, which is good revenue growth, very good metrics. And they've been figuring it out and creating a good customer experience. And so, as much as there's a bias toward folks who have done it before, taking a step back and saying, all right, well, granted, Mark Zuckerberg is a white dude, but Mark Zuckerberg succeeded with his first company, succeeded wildly with his first company. It's like, why can't this group of entrepreneurs do it as well? And so I try to keep balance in that evaluation of management teams too.
it's so much trust. And I don't know if I really thought about it quite as much until, working for a startup, right? But the odds are so stacked against you. You probably know the statistics on that better than I do for like getting to certain stages of funding and your success rates and whatnot. Maybe if you want to talk about that a bit, I'd be interested on the kind of more specifics, but it's really interesting in like the VC space, being on that side and, like working for a company on that. It's like knowing the odds are inherently against you, to fail. So I think finding and vetting companies, I find that really interesting. Again, I don't know much, but I think that, when it goes well, it goes really well. And then when it goes poorly, I feel like you'd have to kind of factor that in before the fact anyways, though, right?
Yeah, it's a high risk business. And the thing to keep in mind is, like one in 10 startups really makes it. And that obviously varies over sort of the lifetime and when you're looking at them. But the thing that I think people don't always recognize is the number of near-death experiences that a lot of these companies have on their way to success. There will be times when there's trouble making payroll. There will be times when you lose a big customer account. And the entrepreneurs that, kind of make it through those times are the ones that have a really good support system. This might be the moment where I like get into my mental health on my mental health soapbox, but
anytime, me too.
It's really important to have those folks who can sort of talk you back from the ledge and, keep you from getting too high when things are good and keep you getting from getting too low when things are tough and bad, because it's like from one day to the next, everything can change. Everything can sort of flip upside down in a startup. And I think knowing the odds probably deters a lot of people from starting businesses. It takes a little bit of insanity to actually go out and start something of your own, and to then become responsible for the people that you've hired, and their livelihoods as well. I honestly don't know how any entrepreneur can be mentally healthy with all of that pressure. I have a lot of respect for those CEOs and co-founders who go through all that.
Yeah. And that's why one of my more recent episodes was with Joy Leary, who's a clinical psychologist. And we were talking about just everything within the whole like financial services ecosystem, VC, working for the kind of fintech startups, anything. It's so much stress and you don't even realize it until it gets to the point of being incredibly bad and kind of like inhibiting your day to day. And I think that just doubles, triples, quadruples when you're working for a startup generally, because like you said, odds stacked against you, you're responsible for a lot of other people. And there's a lot to consider there. So it's never a soapbox on the mental health thing. I think we don't talk about it enough. So anytime on this podcast that we can, I definitely emphasize that. But I do want to sort of switch gears, always down to talk about mental health. But I do also want to talk about the fact that you're an adjunct university professor, and specifically around teaching a course that's essentially a VC 101. I think you told me before this. And I think that would be good use for this podcast too, just because, like I said, selfishly, I don't know a ton about the space, but I think if this is almost could serve as a Cliff Notes version of what people should know and should be interested in within the ecosystem, what they should learn about, I think that would be really beneficial for people. So maybe a little bit of a background on the course that you've taught and where we should start.
Yeah, absolutely. I think so. The course is basically VC 101. It's how do you become a baby VC. That role is usually called the associate or senior associate at a venture fund. And the sort of VCs that you see in the media and the folks whose names you may or may not know, I'm very much in the bubble. And so I don't know who's actually famous and who's not. But those people are partners. So those are sort of principal or general partner level folks. The associate and the senior associate, those are the folks who are typically at a lot of funds kind of in and out in 2 years, are getting their feet wet or getting themselves into the industry, depending on the firm. Our firm is a little bit different in terms of how we recruit and promote talent, but a lot of firms have that sort of 2-year mentality with associates. And the course goes through the responsibilities at that level, which are very much focused on deal identification and deal evaluation. So finding companies, deciding or gathering the data to decide whether or not it's worth a full due diligence effort. But the course really starts with, what does the VC landscape look like? It's not just aspiring VCs who take the class, it's also entrepreneurs who want to learn about the perspective on the other side of the table, and folks who are curious. I don't want to discount people who don't want anything to do with startups, but just want to know about venture capital. And so from my perspective, there are kind of 3 buckets of investors. One is sort of angels and individuals, which I fall into that category, as well as the professional category, folks who, have enough money to be able to take really, really risky bets on very early stage companies. Then there is what we call institutional venture capital, and I'll go into that business model in a second, but these are the people who their entire livelihood is find startup, invest in startup, sell startup, or take startup public, make a lot of money, hopefully. I joke that VC is like the best get rich slow scheme because all of this takes decades to play out, and often it doesn't actually return all that much above what you've invested. The stats on that are pretty sobering for anybody who wants a career in VC and wants to manage a fund. And then the third category are corporate investors. So corporations that are making investments related to strategic objectives. From our perspective at Touchdown, it's never strategic to lose money. So the financial return component of that is very, very important as an evaluation criteria alongside any strategic benefits. But what corporations are able to do sort of beyond an institutional VC is also to extend their expertise and resources to the startups that they invest in. So whether that is something like a distribution deal with a portfolio company, or the ability to share R&D expertise with the portfolio company. All those kinds of things are the sort of money plus, so the additional benefits of working with our corporate VC. So I'm going to go back really briefly to institutional VCs because as an entrepreneur sitting on the other side of the table, it's really useful to understand how those folks make their money, make their living. So where a corporate VC is usually taking cash from the balance sheet and applying it toward an investment program, institutional VCs are taking capital from what we call limited partners. So the entity that holds that capital is called a limited partnership, and it insulates the limited partners from sort of the legal liabilities associated with anything going on inside the fund. Limited partners are anything from a high net worth individual to family offices, pension funds, other sort of big institutions. There are institutions that specifically invest in funds, sometimes corporations, university endowments, basically anybody with a big pool of money that requires an allocation to something very high risk, high return potential. So in order to set up a fund, a venture capitalist, sort of the general partner or the person in my equivalent seat, has to go out and raise money from those folks. And similar to how an entrepreneur has to go raise money, there are hundreds of conversations that happen, and often it takes 18 months to 2 years to raise a fund. And then that fund has a life cycle. So contractually, the fund lasts for 10 years typically, although often they last longer. There are ways to extend them. And then there are sort of 2 periods within the fund's life. The first is the investment period, and the second is, sounds terrible, but it's the harvesting period. So typically in the first 5 years, the investor is looking for new opportunities, writing the first check into the deal, building the portfolio. In the back half, it is looking for opportunities for acquisition, preparing companies for IPO, or shutting down businesses, which is often, the sad reality of VC. So VCs are compensated with what is called the 2 and 20 model. 2% management fee, 20% carried interest. The management fee is based on how much money has been raised by the fund, and that is an annual percentage, not always 2%, but somewhere thereabouts. And the carried interest is basically a profit sharing agreement between the limited partners and the general partners that says, any profit we give back to you over and above the amount that you invested, we get 20% of that. So if the fund is 100 million and it turns into 300 million over time, 20% of the 200 million profit becomes part of the compensation of the general partners or the VCs. The reason for this from, an incentives perspective is you want the VCs to be incentivized to create as big of an outcome as possible, because most of the compensation is tied up in that 20% carried interest. And so from the perspective of the VC, you want to invest in businesses that can get huge, get purchased for really big numbers or go public, and do so in a relatively tight time span of less than 10 years. So if you're the entrepreneur sitting on the other side of the table and you're, building a business that, might not have that huge exit potential or might take a really, really long time to build, that might be why venture capital might not be the right sort of fit from a funding perspective. The other thing that I will say in terms of sort of VC 101, that's an important part of the first lesson that I do, is venture capital isn't right for every business. Just because it's sort of the sexy funding choice, that doesn't necessarily mean it's right for every company. And there's nothing wrong with that. And for certain businesses, it's a lot better to, get a bank loan or, otherwise raise funds for the company. For businesses based on sort of scientific invention, there are a lot of grants available that don't require ownership in the business. And so I think a lot of the folks who are in class as entrepreneurs have a moment of oh, this isn't the only way for me to build a successful company. No, it's one of, many options. And it comes with a lot of obligations as well as benefits. So that's sort of the VC industry overview. I don't know how much time you want to spend on this, Caitlin, but I can also give a little bit of an overview of some of the evaluation kind of criteria. And
no, this is fantastic. I guess kind of adding on to the last part of what you said, for those not really in the space, because you're right, VC is definitely the sexy funding source, but for what reasons? And I feel like some of them are a little you could probably kind of infer some of the reasons for that along with the ownership that comes along with that when you're getting your money from certain sources and whatnot. What are the other reasons that VC might not be right as a funding source for some companies?
VC is really good at funding what I'll call capital light businesses. So businesses that don't need to spend a lot of money on machinery, equipment, real estate, things in the real world, basically. That's why software businesses have traditionally been the focus of VC, is because a little bit of money goes a long way. And in startup land, cash is like oxygen. When you run out of it, you die. So VCs are very, very sensitive to, okay, if you need to go, build a manufacturing plant, if you need to go buy a bunch of expensive equipment, that's going to very quickly dwindle your sort of cash pile. It also means that you need to probably raise a lot more money, and it might take longer. So not saying that there aren't VCs who back those businesses, but traditionally, software businesses that don't require a lot of capital to start and then grow, are the ones that are going to be the most successful raising VC, and the ones that are going to have the best experience with VC. VCs, like people in general can behave really badly when things get stressful, and when, their investment is on the line. And so kind of knowing what you're getting into in terms of what kinds of kind of distressed situations might happen is important. I think businesses that also take a really long time to grow are going to be really tough from a VC perspective. And a lot of that has to do with timing as well. So sometimes markets just aren't ready. And once they hit, businesses that might not have been a good fit for VC all of a sudden are.
Perfect. Well, I do want to get into kind of the current landscape, because you see things every single day on different rounds of funding and whatnot. Obviously, like, we're in the midst of doing different rounds of funding, Series A a little bit later in the year for OnRamp. But what's the current landscape like? 'Cause to me, from the outside, it looks crazy, but I don't know if that's the norm. With some of the funding rounds that I've seen, at least on like the crypto side of things, the numbers just seem absolutely crazy to me. So sort of a two-part question. What is the current, landscape of the VC space looking like right now in comparison to the past, but also like the biggest areas of opportunity from your lens?
I think from a kind of industry status perspective, things are moving really, really quickly and valuations are high. So I saw a chart earlier this week that basically predicted that this year in 2021, there will be more unicorns born than in the last 3 years combined. So a unicorn is a company that's valued at $1 billion or more. So that's an awful lot of sort of valuation put into private businesses, and unicorns are privately funded companies. So from that perspective, that stat tells you a lot about money going into the space, how companies are being valued. It is a very fast moving time as well. I think there's a lot of capital available, a lot of capital looking for higher return opportunities. So if you look at kind of the public stock market, at the bond market, at other security classes, a lot of folks are feeling like those valuations have sort of topped up or are at a point where you kind of have nowhere to go but down for a short period of time. And so you're looking for opportunities where things very much go up and to the right. And so there's a lot of capital available for venture capital investments. And I think I missed, or I'm not remembering what the second part of your question was.
It was going into if there are specific areas of opportunity or sectors that you find to be the most opportunistic right now.
Yeah, it's hard to say because everything's super, super frothy. I mean, I spend most of my time kind of looking at the agriculture space. I have kind of a bias toward investing in really hard problems. So the idea of sustainability, the idea of finding ways to, reduce nitrogen runoff from agriculture, making crops more disease resistant, reduce the use of pesticides, or at least sort of environmentally harmful pesticides. And all of these types of more environmental concerns. These are the types of things that are sort of the big, hairy problems that you think of like innovation as really, really addressing. I think the other space that's really interesting is space and exploration and the innovation that can come from looking out past through the Earth's atmosphere, and the ways that those technologies can then be extended into making all of our lives better. Not necessarily on board with like colonizing Mars, but there's a lot of interesting stuff that's very actually tied to ecology and the environment of satellite technology, and making it cheaper and easier to be able to monitor what's going on from up in space.
Well, those are two of the biggest ones I'd be interested in as well, especially just solving like those huge world problems. I feel like that'd be one of the most rewarding parts of working in VC and investing in companies that have, really strong like ethical drive behind them and what they're doing. So I would definitely agree with you there for my limited knowledge, but I have to ask now, since you mentioned space, do you think that aliens are real?
I do, actually. I think it is highly unlikely that we are alone.
Right. I think it's very egotistical to think that we're the only, creatures alive on this planet, and that there could be like tons more in other places.
I'm with you. The universe is a really big place. There's space for, no pun intended, there's space for all kinds of different life forms.
Too big to even process, I think. But we're getting towards the end, and I have to ask you about some of your favorite things outside of investing, because not all things are VC, and you do have a life. So and we talked about this a bit before, but what are some of your favorite things outside of investing? What do you like to do in your spare time? Any hobbies?
So I have danced since I was a very small person. I took my first ballet class at 3. So I don't do it nearly as much as I used to or as I want to. And actually, if I tried to take a ballet class right now, it would probably end very poorly. But that was my first love. And I am also very passionate about my Swiss heritage. So I still have family in Switzerland, and kind of anything related to Switzerland is also my happy place. Chocolate, cheese, very stereotypical, but I love those things. And I'm also a really avid reader. So this year I have sort of I guess for avid readers, a pedestrian goal of 30 books, but for the normal working person, that sounds like a ton. But I really love to just sort of sink into some good fiction and spend some time in a world that I don't inhabit on a daily basis.
Good to get away, right? Even if mentally. But what are your biggest book recommendations then for the listeners?
Oh my gosh. So that's a tall order. For folks looking for interesting nonfiction, I recently read Trevor Noah's Born a Crime. Fascinating, incredibly well written. Loved it. I am a huge fan of slightly absurdist fiction. There is an author called Jasper Fforde who has written a number of series that are kind of dystopian, alternate universe type books. His first book was called The Air Affair, about literary detectives who jump into novels, so like Jane Eyre and other classic novels, to make sure that when the reader is reading them, the characters are actually doing what they're supposed to do and not like off in a different section of the book doing something they're not supposed to be doing. So really sort of silly, but really, really fun. And I'm always excited to read one of his books.
Well, I'm going to take that one down for later because that sounds like a really interesting one. And I need to read all of the books that I haven't read on this bookshelf and beyond. So thank you for that. I guess wrapping all of this up for those listening who, whether they are interested in going into VC, I know a couple people that I will be sending this to directly who are, but what is your advice for breaking into this space? For those who listen to this, they got the Cliff Notes 101 version of this. They heard about the updates on the landscape. What do they do first to try to get involved and to get a career out of this?
It is the first thing I'll say is there's no one path to becoming a VC. And so people with a lot of different backgrounds, a lot of different expertise have a place in the industry. It takes a lot of relentless networking, I think is the most impactful advice I can give. Have a lot of conversations. It's changing, but the industry still very much hires based on referral. A lot of times jobs aren't posted. And so unfortunately, a lot of the opportunities just aren't out there and available. And the more conversations you have, more you put out there what your expertise is, what your interest is in investing and in VC in particular, the more you get the message out there, the more likely it is that somebody will have your name at the top of mind when an opportunity comes up. Subscribe to the newsletters, follow awesome people on Twitter who are going to be sharing opportunities, and just read as much as you can about the industry.
networking and using Twitter heavily. I could not have said that better myself. That is like the first thing I suggest to everyone that I talk to who will listen. Well, that's a perfect wrap up. Selina, thank you again for joining me. This was wonderful. I might have you back on for another VC talk at some point. We'll see how things go down the road here. But where can people find you for insights on social media?
So I'm on Twitter at Selina Troesch. Look at the show notes for how to spell that. It's not immediately apparent. Also on LinkedIn. I am not a Facebook user, so you can have a mental health conversation about that one as well. But most of my social media activity is on Twitter. So at Selina Troesch.
Beautiful. Well, there we go. Thank you again. And thank you to everyone who listened. We will be back next week with another episode. But in the meantime, stay tuned for updates on our Twitter handle at Chicks of FinTwit, and we'll catch you next time.